Good afternoon, everyone, and thank you for joining Mike Simpson and I today. As mentioned in the email invites, we are celebrating Mike's 5-year anniversary managing the NCM Dividend Champions Fund. So let's begin. Mike, thanks for taking the time. We really do appreciate it. The past 5 years have not been without their challenges, right? And for us, what has stood out is your ability to outperform the index and the benchmark on its worst 10 days. How have you managed to do that again and again over the past 5 years, Mike?
Well, thanks, Chris, and thank you everyone for joining. Basically, you start with the construction of the portfolio. We're not looking for companies that have a lot of promise, may have some revenue, may not have any profits, but we're looking for solid companies that can pay a dividend and grow their dividend. In fact, I recently tabulated all of the companies in the NCM Dividend Champions. We have about 30, 37, 38 names, and of those names, 34 of them not only paid a dividend, but they raised their dividend. The average dividend increase was 8%. Now, that's not something you can get from a GIC, but the essence of your question, it is all about stock selection. It's all about portfolio construction. We want to avoid the dividend cutters, the BCEs, the Algonquin Power, the Northland Power, Allied Properties, Superior Plus, Northwest Health Care, New Flyer, etc., etc.
Okay, thank you for that. And so, by avoiding the dividend cutters and focusing on the dividend growers, you were able to deliver superior performance, particularly on the 10 worst days over the last 5 years. And you know what? I'd be remiss if I didn't mention that your track record over the past 5 years has been quite good. What really stands out for me from that, looking at the calendar year performance, is 2022. 2022 equities and bonds were down, and you were up. Yes, your F class was up 1.5%, but it's so different from the competitor set out there. Is that because of the quality of the the quality of the dividend payers you were buying, or did you do anything differently in 2022?
There was nothing different. There was some geopolitical events. We don't manage to macro events. We use a macro overlay, but we're not. What I like to say is we don't ignore the macro, but we
Right.
don't manage to every latest macro movement because, as you know, with the new president, he tweets a lot, and you're not going to change your portfolio on every tweet. But basically, 2022, there was a little bit more cash, not a whole amount. There was 8% cash, but you had companies that were benefiting from, certain circumstances, Tourmaline growing their dividend, paying special dividends. I still own that. So, and Tourmaline continues to raise their dividend and pay special dividends. So it was all about stock selection, and it was all about not wanting to chase, the most popular stocks. That's always been our philosophy.
Right. And it's interesting. We've referred to the fund as we call the Div Champs Fund, obviously, but in some of our advertising and some of our marketing, we've called it the big, boring, beautiful portfolio. And it seems to me that, dividend payers that just continue to plod along and pay their dividends and grow their dividends are exactly what you're looking for. And that really is a bit of the secret sauce when it comes to your success.
Yeah, absolutely, Chris. So it's not only about paying a dividend, it's not being seduced by high dividend yield. It's
Uh,
really going through the financials. Can this company in the first place pay a dividend? And can it grow its dividends? So we look for that. Are they treating their employees well? Are they reinvesting in the business? And also, leverage is very important because if you have too much leverage, sure, you can have better return on equity because by definition, your equity component is smaller and your debt component is higher. But can you pay a dividend? Can you grow your dividend? And let's face it, this year with BCE, with recently with Northland Power and Allied Properties, companies that you thought were safe, companies that may have been in the dividend aristocrat index, you have to do your homework. So dividend investing is an active sport.
Yeah, interesting, interesting. So, okay, so we certainly have had some challenges thrown at us in the past year, particularly when it comes to U.S. leadership. But how would you describe, and this is a bit of a two-parter. The first part of this question is, how would you describe what we went through in 2025? And that's going to lead me to a question about 2026. But how would you describe what we went through in 2025?
Yeah, there's a number of ways to dissect the question. I mean, first, we're here in Canada. I could start with that and then move on to the US and then the world. So in Canada, we got a new government, and the government which tilted to the center or slightly right, which is good. The government is now interested in major infrastructure projects where we weren't for the past decade. But in Canada, we're responding to the first once in a century very high tariffs. Tariffs were introduced the first time this high in 1930. So I would describe, the market in Toronto or the Canadian market. As of November 30th, the market is up about 26%, but it's been really fantastic time to be a gold investor. If you take out gold and silver and precious metals for the TSX, as of November 30th, the market was only up 15.8%. So that's the macro with the moves that Donald Trump's doing with, trying to place tariffs on everyone, trying to put sanctions on people he doesn't like or countries he doesn't like. A lot of central banks have been buying gold. Gold is at a fantastic move. I'm not telling you I'm wise enough to tell you when that move will end, but
Right.
I would say we have a bit of gold in the portfolio, not a lot. Gold is a commodity that can be quite volatile. So what I would suggest to you is the returns you've seen in 2025, just in particular, this comment is to the gold and precious metals, may not be as robust in 2026. So, vis-a-vis tariffs, Canada is a trading nation. Our largest trading partner has been since Confederation and to the present been the United States. Recent Statistics Canada data show that our trade with the US has dropped from 76% of our exports to 74, so a very glacial reduction. But the key in 2026 will be the renegotiation of, Canada, US, Mexico trade agreement. So expect some news in the later half of the year. Call it around after the Canada Day celebration because that's when it expires. So on July 2nd, we should have some news how we're going to go. But interesting tidbit, the U.S. is big in AI. We all know about that. And the U.S. has 53 nuclear reactors, but 100% of their enriched uranium comes from Canada. So Canada does have some key cards it can play with the US vis-a-vis trade negotiations.
Gotcha. Okay, interesting. So you covered a bunch of topics there that I'd love to expand on. But first, I want to expand on the USMCA trade agreement and your thoughts there going forward. But first, one of the questions I think that's on the minds of a lot of advisors is, do you feel 2026 is a year to start taking profits off the table? And if so, why? And if you don't feel that way, again, why?
No, I think my earlier comments about the TSX performance,
Yeah.
very good. Even good without gold and silver and precious metals. But if you look at some of the really huge winners, I'll just read some of them. Discovery Silver up more than 1,000%. Eris Mining up 293. Celestica 255. Lundin Gold. I don't have to go through all of them, but I believe 9 of the 10 top performers year to date on the TSX are mineral related companies. Some of the laggers, Thomson Reuters, which we own. I don't think that, lawyers are going to go out of business. And I was talking to some lawyers. The tools that Thomson Reuters has for them, Westlaw, are still in demand. And Thomson Reuters is embracing AI. They're incorporating it into their legal software. So I think there's a good chance some of these beaten up names, some of the names that got beaten up too harshly will bounce back. And another name that we own and staged a little bit of a comeback from the summer, Cargojet, all we need to do is see a little pickup in transportation or industrial freight, and they should do well. They have about 92% of the Canadian air cargo market. Um, it's a little different than the railroads, but they provide an essential service, especially with healthcare. And seasonally, they're going to get a little bit of a boost because there's more uh, Christmas gifts, there's more last minute shipping. But nonetheless, their stock really got punished for volume dropping. But it's a normal course of the business cycle. And I think with any little recovery, I think the stock, can recover and do better from here. So it's about understanding a business, understanding that if uh, business isn't as robust as it once was for cargo jet, they don't have to spend as much on planes and other capital equipment. So their free cash flow actually goes up in a slower business environment. So something that we do a deep dive on.
So you mentioned Thomson Reuters and cargo jet, and you don't feel that 2026 is a year to take profits off the table. But by mentioning those two companies, are they examples of sort of a shift that may take place in the Canadian marketplace going forward? In other words, what got us or what drove the good return this year might contribute to a good return next year, but there are companies like Cargojet and Thomson Reuters that also could have sort of turnaround years, along with a whole bunch of others to really drive that Canadian market. Is that what you're
Yeah.
feeling?
Yeah, so a number of things. I think you could see the broadening out of the market, especially in Canada. I think you can see more of the value type plays do better. And that would apply to both Cargojet and Thomson Reuters. And we don't have a big technology sector in Canada, but you're seeing it in the US, a broadening out of the rally and even the rails. I own CN Rail, I've owned CP in the past. Even the rails can do better as you get more trade uncertainty worked out, and as you come closer to a deal with the Canada, U.S., Mexico trade agreement, closer to Canada's birthday on July 1st.
Okay, so let's go on to there for a second. So what could that USMCA trade agreement look like? I mean, is it something that we know there's an automatic review in 2026? We know that the current USMCA covers, I think, somewhere in the neighborhood of 90+% of the goods that are traded back and forth between the two nations. Do we think that we could see a continuation of that kind of level of coverage, or is it something that's going to drastically change?
Yeah, all key questions. So Canadian and US economy are closely integrated, not only supply chains, not only logistics, but also with people and human capital, et cetera, et cetera. So I think like when you have aces like the uranium,
Right.
when you can say, hey, look, we want to help rebuild all the homes in Southern California that were lost to fire with our lumber. We want to help bring down inflation by getting our lumber to your builders and home improvement people a lot cheaper without tariffs. We can help you bring down inflation. I think that's a good um, ace for the Carney group that are negotiating down south. Also aluminum. There's one smelter in Quebec that produces 90% of what the entire U.S. aluminum industry produces. So those are our key bargaining points. And the U.S. farmer, I mean, farmers, Canada, the U.S., they're hurting. So why Trump would want to put tariffs on Canadian potash makes no sense. It's hurtful, harmful to the U.S. farmer. So I think we've got a lot of different levers we can pull. Naturally, if you're sitting in a business seat or you're on a board, you want the answer now. But the tact or strategy taken by the Carney government is to let's wait until July 1st. But perhaps we can get one side deal. I don't know if it'll happen, but if you take aluminum and you say, look, we can help lower your cost. We're a friendly nation. we produce aluminum from hydro. We're not, it's clean aluminum, so perhaps it's there. The what's unknown is whether, you can reach a deal before July 1st. But nonetheless, I think trade will evolve, but it's going to take many years for Canada to develop new trade partners. So I think, I think we'll have something that, you know most people will like when we come around to July 2nd, 2026. So we just have to wait and see what gets negotiated and what's all in the details.
Yeah, yeah, good point. Good point. Well, you know, you brought up uranium, you brought up softwood fertilizer and aluminum, and if we can help, if we've got some sort of deal for those, one or all of them,
Yeah.
within a new USMCA framework, then to your point, that can help bring down US inflation,
Yeah.
which a lot of people are worried about, right?
And sorry, there's also another thing which or the government is working on. It's quotas. Like, okay, you have concern about steel. We'll agree to only export this amount of quota, and if we exceed that quota, then you can slap tariffs on. So, that's something that, would be acceptable to the US. So we'll just see what is negotiated. But naturally, everyone wants to know how are things going to unfold. But unfortunately, at this time, we just have to wait.
Right, right. And in our case, in the Canadian economy's case, our Canadian economy has proven to be quite resilient, particularly over the last 3 months, which is nice to see. But what does this, so let's say we've got a new USMCA trade deal going forward as of July or August of next year. Does that bode well for both Canadian and US equities?
Uh, yeah, absolutely. We're a small nation that trades. We have lower interest rates in Canada than the US. Very very shortly in the US, I guess there's going to be an announcement. I haven't seen what the announcement is, but I'm guessing or betting. Let's not use betting. I'm guessing that the U.S. Federal Reserve lowers rates by 25 basis points. But the other wild part is if Trump really wants a, call it passive Federal Reserve, he really wants a, call it obedient Federal Reserve governor and board.
Yeah,
And he
yeah,
wants rates to go lower. That's good for Canada because we have a lot of hard assets, and you're going to create this tension in the market where, oh yeah, like maybe the job picture isn't the greatest, but you're nowhere near your 2% inflation target. So that all plays into Canada. And what we haven't mentioned is that over the last 12 months, there have been a number of takeouts in the Canadian market, over 30. In fact, I'm not looking for takeouts. But in my Dividend Champions funds, I lost three Canadian companies: Parkland, which I've known for a long, long time,
yeah.
Andlauer Health, and Dental Corp. So, if the market stays cheap, then basically you'll see more of that. I don't necessarily want to see that as a, call it, North American Canadian based manager, but nonetheless, it will happen. There's other larger Canadian investors, there's industry players, there's American players, there's foreign players that if they see cheap companies in Canada, they'll continue to be scooped up.
Yeah, so is that because the valuations are just so favorable for them? In other words, do we undervalue our own companies as
Yeah, I mean
Canadians?
that's a great example. So, yeah, like we in Canada tend to put too much faith in bigger companies, but there's a great host of small and medium-sized companies. So if you look at my case in the NCM Dividend Champions, Andlauer Health, that was formed by a great entrepreneur, Michael Andlauer. His firm was bought by UPS, a great big American company. They're in Canada, but they're going to get bigger with their acquisition in Canada and with healthcare, transportation, and logistics. Parkland was bought by Sunoco, another U.S. company, and Dental Corp was bought by a Chicago-based U.S. private equity firm. So, absolutely, the valuation brings these companies to Canada. They're going valuation in a much stronger U.S. dollar. So
Yeah.
it becomes very enticing. Like they go, okay, Canadians, you don't want to. you don't want to value your company. Like I've always said, even on BNN, I said, Canada, it's not a call to arms, it's a call to invest. Invest in your home market, or you'll keep losing these great medium-sized companies.
Right, right, right. So yeah, even though the market has done so well over the last calendar year, 2025, if you will, done so well year to date, I should say, there still is tremendous opportunity and upside, it sounds like, within the Canadian equity, within Canadian equities, particularly when it comes to undervalued Canadian equities. Yeah,
Yeah, absolutely. I mean, in Canada, similar to the US, there's a big index contingent, and some of these small, medium-sized companies don't get included in there. So that creates opportunities for people like me that like to kick the tires and go, you shouldn't be this cheap. Yeah, you
right,
sacrifice a little bit of liquidity, but at the end of the day, if you're buying a good, solid business, you're not really worried about what happens on a day-to-day basis. You just want day-to-day basis stock trading wise. You want the company to go out there and execute. So,
right.
tremendous opportunities in Canada still. Absolutely.
Yeah, okay, interesting. Thank you for that. That's a great segue into sort of what sectors or industries do you like both in Canada and the US, and why?
Yeah, I think like on my earlier comments about if inflation is going to be a bit stickier, I think energy offers a good opportunity.
Yeah,
Now, I like to go to companies where I don't necessarily like to take the commodity risk. Sometimes you do, but I can buy a freehold royalty. It's paying about a 7.5% dividend yield. As long as oil is above $50 US, they'll continue to pay their dividend. They get about 50% of their production from the US, and their Canadian lands go all the way back to the Hudson Bay land grant that, was happened in the 1600s. Um, we're building pipelines to the West Coast to transport LNG. So that's why I would like a Pembina or a Kiera. And naturally, natural gas, I like a little bit better, vis-a-vis oil right now. But like tourmaline, I mentioned it earlier. I've held that all through my 5-year tenure. Dividends, not only dividends, growing dividends plus special dividends. So, best management team led by Mike Rose, and they'll continue to do well. So, no issues owning that. And a little name, former income trust. It's not your father's chemtrade anymore, but they're into chemicals, sulfuric acid, sodium chlorate, ultra pure, ultra pure acid that's going to be going into the new semiconductor plants in the US, chemtrade, and also produce chemicals for the water treatment industry. So they're going to separate that division and they're going to highlight it, so they should get a higher valuation in 2026. So those are just some of them, but also industrials. Industrials are a wide range of companies, from someone like Tormont that has Caterpillar equipment in Manitoba, Ontario, Quebec, Labrador, and the far north. They should benefit from infrastructure, also more mine development. And for all the wrong reasons, Thomson Reuters in the TSX is shoved in industrials, but that's just another good one. And we don't like to see violence and wars, wherever, but Republic Services will pick up the garbage if there is a earthquake, somewhere. They'll pick up the garbage in Missouri. So they do their job day in, day out, and collecting garbage is a very steady. It's not recession resistant, or it's not recession proof, but it's very resistant to slowdowns because they offer an essential service. And they also have a little side business from their landfills where they can capture the methane and then sell it to utilities as basically green natural gas.
yeah, interesting, very interesting. Okay, as promised at the top of the call, we let people know that if they asked a question, we'd do our best to answer it during the presentation. So there's a couple of questions here. Number one, what are your thoughts on the telecom sector in Canada, particularly Telus and Rogers?
Yeah, great question. So first, I'll start with Rogers. So Rogers, they've gone through the merger with Shaw. Rogers has something interesting in their sports. I guess they right now they own 75%. Later in 2026, they may own. They could buy out their minority partner, so they'll have 100% control of what's known as Maple Leaf Sports Entertainment. CNBC, I don't know why they're valued so high, but the Maple Leafs got a price tag of 4 billion, the most valuable hockey team. So Rogers is interesting from that perspective. I don't own it. They seem to be doing well in a competitive market, but I don't own it. I'll just mention the one I own is Quebecor. They've integrated Freedom Mobile very well. Good balance sheet, good payout ratio. So now, lastly, I'll go on to TELUS. So TELUS very wisely stopped their dividend growth. I think it took them too long to realize that. They have a little ace in their sleeve. They'll spin out their TELUS Health, which I think will be more successful than TELUS International. But it's somewhat of a a dogfight industry, a very mature industry. So TELUS, I think they've got religion on lowering their debt, lowering their payout ratio. I don't own TELUS. The one name I own is uh, Quebecor, and I'm looking at really the angle of how valuable is Rogers sports franchise. So I'm doing more work on that. And I just
Right.
want to know if the value for these leagues and teams has peaked or if there's still more valued or if it's just going to plateau because the value of franchises is very expensive and the selling of TV rights, which is the main driver for the leagues, I just want to know, try and figure out how much, how long that can continue to go with rising revenues from TV rights, et cetera, et cetera.
Yeah. Good point. Very good point. And yeah, the valuations on pro sports teams seems to be over the last decade just going through the roof. So yeah, yeah, interesting. And you're right. Are they going to continue to grow, or are they at peak valuation now? So good points. Both of them good points. Another question. Um, Netflix. How do you feel about Netflix?
Yeah, Netflix is a name we owned in the past. Not your traditional dividend stock, doesn't pay a dividend. We can own something that doesn't pay a dividend with the expectation that it would pay a dividend in 2 years. Netflix throughout its history has never made any major acquisitions. So Warner Brothers, even though it's a great asset, they're paying a lot of money for it. Um, they'll add debt to the balance sheet, but if they stick to a very disciplined, rigorous process, they can reduce the debt. I don't own it now because until you figure out who's going to win Warner Brothers, I don't have to be there. Also, Netflix, if you X out their growth rate, trades at a very high price to cash and price to earnings multiple. So, I was fortunate to sell Netflix before they announced that they were the winner of or the initial winner of Warner Brothers
Right.
Discovery.
Yeah. Yeah. The
Uh,
first winner.
so
Yeah.
yeah, so like Netflix is a great franchise. We use it in our family, and it's like some people would. I'd have a riot in my family if I canceled the Netflix subscription, and great pricing power. But I'm gonna wait and see how it plays out. So no Paramount, Skydance, no Netflix. So I'm just gonna wait and see. And sometimes it's better to be on the sidelines.
Yeah, no, fair enough, fair enough. Okay. So all of this, talking about TELUS, talking about Rogers, talking about Quebec Core and Netflix. The fund is called the NCM Dividend Champions Fund. So what is a dividend champion in your eyes, in your opinion?
Yeah, Dividend Champions is a company ideally that's in an industry, has a dominant position in an industry or their sector. There's not a lot of competitors. It can pay a dividend.
Now you said pay a dividend within 2 years if it doesn't pay one currently.
No, that's just a non-dividend payer. Sorry.
Okay, gotcha.
Yeah, I'm
Sorry.
just
Yeah. So pay a
it can
dividend.
pay a
Yep.
dividend. It can grow their dividend, has a good balance sheet, but the key is just the consistent, dividend growth. Like Emerson Electric, which I own in the portfolio, they've raised their dividend every year for 69 years.
Wow.
Fortis has done it every year for 51 years. So those are rock stars, in the fund. There are times where some of these stocks may get expensive, but it also plays into what I deem a core holding. A core holding I'll never take below 1%. So as Fortis gets a bit weaker, rather than selling it, I'll be adding to it. So, the dividend champion, just I'll wrap it up. Strong management, pays a dividend, good balance sheet, and has the ability to grow their dividend, and it really is in most cases, a leader in their industry or field.
Okay, that's great. Yeah, I'm just writing that down. Thank you, and a leader in their field. Okay. Okay, fantastic. And so, just one or two final questions, maybe just one, but that is, you talked about 2026 not being the time to take profits off the table. You talked about how good 2025 was, that there are still some very good opportunities in 2026 to be invested in the marketplace. Is now the time to buy the Dividend Champions Fund?
Yeah, absolutely. I mean, what's going to get you ahead, what I've found out over 30 years, it's the time in the market, not timing the market. We will pay a distribution this year in the NCM Dividend Champions because of our successes, as I told you about the Parkland generated a capital gain, also the Dental Corp, also the Andlauer Healthcare. But now's the time to get in. You get dollar cost average. Why time the market when, I was talking to some members of our sales team, people were saying, oh, I should have got it in April. So you get in. You may not get in with all of your investment, but if there's any pullback, you use it to dollar cost average. So, um, you know, don't try to time the market. Just try and buy what we're buying, buy great companies that have the ability to pay a dividend and grow their dividend. So sometimes you got to tune out the talking heads and the newspapers that say, a correction is imminent, and just buy good companies that'll continue to pay a dividend. So, yes, now is a good time to buy, and really ignore the news, which is coming at you fast and furious, not only from the traditional methods, but also from the newer methods, internet, social media, etc.
Yeah, well, thank you for that. And you alluded to the fact that, the garbage has got to get picked up every week, regardless of what's going on in the world, right? So,
Yes,
own that company, own businesses that just continue to plod along. It sounds like anyway,
that's right. I mean,
is what you're referring to. Continue, they've got good balance sheets. They pay a dividend, they grow their dividend or consistently grow their dividend over time. Yeah, okay. Thank you very much, Mike. Is there anything you'd like to add before we sign off here?
no, I'd just like to thank all of the investors in the fund. I still see great opportunity in Canada and the US. We don't feel beholden to the index. We don't feel, we have to chase things. We're just looking for great companies, and we do our work, and we do our best to avoid the dividend cutters. So it's all about preserving your capital. We're not always going to have years where the market's up 26%. But
Yeah.
take a look, calling your NCM sales rep, take a look at our downside protection because we tend to do better in down markets as opposed to up markets. And we all know we're not always going to get robust up markets.
Yeah, no, appreciate that. And one of the things I will add to that is that we as an organization have such high active share. Typically, our solutions don't look like our competitors out there. In fact, every time we run a comp, a head-to-head comp, very often is the case, we have zero stock overlap when we're comparing competitor products to ours, such as the Dividend Champion Fund. So if you're interested in having a comp like that run, it certainly helps with the KYP aspect of it. We'd be more than happy to do that for anybody and everybody that's interested. And you'll be amazed, like we are from time to time, at the fact that Dividend Champions Fund really doesn't look like anything else out there. And as we said earlier at the top of the call, you've done a tremendous job, Mike, just managing through the downturns and being able to outperform not only the index but the benchmark over the last sort of ten worst performing days over the past 5 years, but also delivering positive returns in 2022 when pretty much the entire world was down. So thank you for that. Thank you for your continued guidance and stewardship of this fund. And thank you for your time today. We certainly do appreciate it.
Okay. Thank you, everyone. Take care. Bye bye.
Take care, everybody.